Let me tell you something that almost nobody has bothered to explain to you properly. Right now in 2026, there are three separate pieces of good news for American seniors, three different pots of money with your name on them. And most people watching this will walk right past all three. Not because they don't qualify, but because nobody ever told them these existed. After months of headlines about cuts and freezes and everything at the store costing more, I want to do the opposite today. I want to hand you three ways to put money back in your pocket. One of them can wipe out a bill you are paying right now straight out of your Social Security check. One of them can take a big bite out of the heating and cooling bill that punishes you twice a year. And the third is an entire second check every single month that a huge number of seniors are convinced they're not allowed to get, and they are flat wrong. Study after study finds that roughly 1 in 3 older Americans who qualify for these benefits never claim a single dollar. That is money sitting there that belongs to you. So stay with me, because I'm going to walk you through exactly what these three are, who really qualifies, the one income mistake that makes people count themselves out when they shouldn't, and exactly how to claim each one. Here's how this is going to go. I'll take them one at a time in plain English, no jargon. For each one, I'll tell you what it is, who actually qualifies, and I mean the real income numbers for this year, not some vague low income, and the exact way to claim it. I'll also stop and warn you about a scam that follows this kind of money around like a shadow. Because the moment there's a benefit seniors can claim, there's someone on the phone trying to steal it. And I'm saving the biggest one for last, so stick with me all the way through. Most of all, pay close attention when I get to the income part, because that is where thousands of people wrongly decide they earn too much and hang up on money that was theirs to take. My name is Walter Barron. I've spent more than 15 years as an estate attorney sitting across the kitchen table from families and going through the fine print of these programs line by line. I'm not selling you anything today. I don't work for the government and I don't make a dime whether you claim these or not. I just read the rules so you don't have to. And I tell you in plain words what they actually mean for your money. And before I start, one thing. I don't care if you're 62 or 92, and I don't care if you're sure you make too much. Watch all three of these before you decide any of them isn't for you, because the people who assume they don't qualify are exactly the ones leaving the most on the table. Now, let me answer the question I can already feel some of you asking. If this is real, why has no one ever told me? It's a fair question, and the answer is the same frustrating reason for all three. These programs pay out what you apply for. There is no person whose job it is to look at your situation, pick up the phone, and say, based on your income, you qualify for this. Let me get you signed up. That person does not exist. The benefits sit under confusing names behind applications most people never see. And the folks who need the most, older Americans on a fixed income, are exactly the ones least likely to go digging through a government website to find them. So they just sit there unclaimed year after year. Today we fix that. So here's the first piece of good news, and it's one you can start on this week. If you're on Medicare, you are almost certainly paying a premium for Part B. That's the part that covers your doctor visits, and it comes straight out of your Social Security check before you ever lay eyes on it. In 2026, that premium is a little over $200 a month. Read that again. That's more than $2,400 a year pulled quietly out of your check month after month. Now, here's the good news. There is a program. It's called a Medicare Savings Program where your state will pay that premium for you. Not lower it, pay it, which means those $200 some a month stop coming out of your Social Security and your monthly check goes up by that amount. For a lot of seniors, that is the single biggest raise they will get all year. And it doesn't come from Congress, and it doesn't come from a cost of living adjustment. It comes from a program almost nobody bothers to apply for. And it can reach further than just the premium. There are actually a few versions of this program. The most generous one for the lowest incomes doesn't just pay your Part B premium, it also wipes out your Medicare deductibles and your copays. So those surprise bills after a doctor visit stop landing in your mailbox entirely. The other versions for slightly higher incomes cover the premium itself, but every single version of it puts real money back in your pocket. Now, who qualifies? And this is where I need you to stay with me because this is exactly where people count themselves out and hang up on their own money. This is based on your income and the limits are higher than most people guess. For 2026, Depending on which version you're looking at, a single person can have a monthly income up to somewhere around $1,800 and still qualify to have that Part B premium paid. And for a married couple, the line is higher still, up into the 2,400s a month. So before you wave this off and say, I make too much, actually go check, because a great many people who are dead, sure, they earn too much land right inside that window. Do not disqualify yourself in your own head at the kitchen table. Let the application do the math. Let me put a face on it, because the numbers don't land until you picture a person. Think of a widow. I'll call her Margaret. Margaret is 73. She gets a modest Social Security check, and like clockwork, every month a little over $200 of it vanishes for her Medicare Part B before the money ever reaches her bank. Margaret always assumed those programs were for other people, poorer people, not her. But when someone finally sat down and ran her actual numbers, she was under the line. Her state took over that premium. And just like that, her Social Security check was $200 bigger every month, around $2,500 more a year in her pocket. And nothing about Margaret changed, except that somebody finally showed her the door was open. Most people never get that somebody. How do you claim it? You apply through your state's Medicaid office or Postapod, and this is the easy button hover. You get free help from your local state health insurance assistance program. People call it SHIP. They will walk you through it, and it costs you nothing. It is free to apply, and you never ever pay anyone a fee to sign up for this. And when you make that call, you do not need to be an expert or have every scrap of paperwork memorized. You just say in plain words, I'm on Medicare, I'm on a fixed income, and I want to know if I qualify to have my Part B premium paid. That one sentence is enough to get the ball rolling. They'll ask you a little about your monthly income and walk you through the rest. You don't have to know the name of the exact program or which version you fit into. That is their job. Your only job is to raise your hand and ask the question. The people who get this money are simply the ones who made the call. And that brings me to the warning I promised, because this is exactly the kind of money the scammers love. Here's how it works. The moment word gets out about a benefit like this, the phone calls start. Someone calls, sounds official, says they're from Medicare or Social Security, and tells you they can get your premium refunded or your new benefit started today. They just need to confirm your bank account or your Social Security number or your Medicare number. Stop. Hang up. Medicare and Social Security do not call you out of the blue and ask for that information to hand you money. They don't. If someone on the phone is rushing you and asking for your bank details to release a benefit, that is a thief, not the government. You go to the source yourself, your state office or SHIP, and you never give your numbers to whoever called you. All right, that's the first one. Let me give you the second, because this one hits a bill that I know keeps some of you up at night. Your energy bill. There is a federal program run through your state called the Low-Income Home Energy Assistance Program. Most people have never heard of it, and the ones who have assumed it couldn't possibly be for them. It helps you pay your heating and cooling bills, and depending on your household, your income, and where you live, it can put anywhere from a couple hundred up to around $1,000 toward that bill. Usually paid straight to your utility company, so you never have to touch the money at all. Now, here's the part most people miss, and it's a big one. When they hear heating assistance, they picture the dead of winter and nothing else. But this program covers cooling, too. The air conditioning that for an older person in the heat of summer is not a luxury. It's a safety issue, and there's usually a crisis piece on top of that. If you've gotten a shutoff notice or your furnace or your air conditioner has quit on you, there are emergency funds specifically for exactly that. And here's the relief in it. Claiming this does not reduce your Social Security. It does not count as income against you, and it doesn't take a thing away from anybody else who needs help. I do have to be straight with you about one thing, and it's the reason I'm telling you now instead of 6 months from now. The money for this program is limited, and when a state's funding for the year runs dry, that's it until it gets refilled. States hand it out first to the households they consider most vulnerable, and older Americans on a fixed income are usually right at the top of that list. But you have to actually be in line. The application season is open right now through the spring, so do not put this one off until the cold sets in and the money's already gone. Picture a retired couple living on his pension and both their Social Security checks, watching the gas bill climb every winter and rationing the heat to make it work. They'd never applied for a thing in their lives and they weren't about to start. Figured it was charity. Figured it wasn't for people like them. One phone call later, a few $100s went straight to their utility. The crisis fund fixed the furnace that had been limping along for 2 winters, and the cold months stopped being something they dreaded. That help was sitting there the whole time. They just had to ask for it. How do you claim it? You contact your local energy assistance office. Every state has one. Or do the simplest thing in the world and dial 211. In most of the country, that's a free helpline that will point you straight to the office that handles this where you live. Free to apply. And once again, nobody legitimate ever charges you a fee to sign up. Okay, here's the third one. And honestly, for the right person, this is the biggest of all three because it isn't a discount or a bill being covered. It is an entire second check. It's called Supplemental Security Income, SSI for short. And I need you to hold two ideas apart in your head because this is exactly where people get it wrong. There's Social Security, the retirement check you earned by working all those years. And then there's SSI, which is a completely separate federal check for people who are 65 or older or disabled and who are living on a low income with limited savings. And here is the mistake that costs people the most. Most folks assume that because they already get a Social Security check, they can't possibly get this one too. That is simply not true. If your Social Security check is small, you can very often receive SSI on top of it to lift you up. One does not automatically cancel out the other. For 2026, this went up. There was a cost of living increase at the very end of last year, and the most a single person can receive from SSI is now about $994 a month, and for a couple it's just under $1,500. Now, if you already have some Social Security coming in, your SSI is usually reduced by part of that, so you might not get the full amount, but reduced is not nothing. A partial SSI check every single month for a senior on a tight fixed income can be the difference between the month working and the month not working. Over a year, even a partial check adds up to thousands of dollars you're not getting right now. And here's where people count themselves out again, so let me ease it. It's true this looks at your resources, your savings, but the home you live in does not count, and your car generally does not count. So do not look at the house you own and decide you're disqualified before you even ask. This benefit was built for exactly the person who worked their whole life, gets a modest Social Security check, and is quietly coming up a little short every single month. Think of a man I'll call Tom, 38 years on the job, a small pension that went away, and a Social Security check that just doesn't stretch to the end of the month anymore. Tom was certain SSI was welfare, and that he'd never see a dime of it. He was wrong on both counts. A partial SSI check landed on top of his Social Security, a few hundred every month. And for the first time in years, the arithmetic worked. If that sounds like you or like someone you love, this is the part to lean in for. How do you claim it? You apply directly through the Social Security Administration online, over the phone, or in person at your local office. And it is free to apply. You do not need to pay a soul to file this for you. Now let me tell you why this year specifically is the year to go check all three, even if you looked once before and got turned down or gave up. At the very end of last year, the annual cost of living adjustment moved the numbers. The SSI amount went up. The income limits on these programs shifted and the Medicare premium changed. And when those numbers move, the line for who qualifies moves right along with them, which means people who were just barely over the edge last year can be sitting comfortably under it this year without changing one single thing about their own lives. So if you checked 2 years ago or 3 and decided you made too much, that decision is out of date. The line moved, go check again. I've watched this happen up close. Someone gets told, no, you're $50 a month over the limit, and they take that like a life sentence and never try again. But that limit is not carved in stone. It climbs a little almost every year when the cost of living adjustment hits. So that $50 that shut the door last year, this year the door may already be open. And nobody is going to call to tell you it swung wide. The only way you ever find out is by checking again. It cost you one phone call. It could be worth thousands. So let me add it all up for you because I think when you see it stacked together, it lands differently. The Medicare Savings Program, if your state takes over that Part B premium, that's more than $2,400 a year back in your Social Security check. And in the most generous version, your deductibles and copays disappear on top of that. The energy assistance up to around $1,000 a year toward heating and cooling paid straight to the utility. And SSI, for the right person, that's up to nearly $12,000 a year. And even a partial check is thousands. Add those together, and for a lot of you, we are not talking about pocket change. We are talking about the difference between a retirement where every month is a white-knuckle squeeze and one where you can finally take a breath. And here's the thing I want you to really hear. The seniors who collect all of this are not smarter than you, and they did not earn it more than you. They simply found out it existed and they filled out the form. That is the only difference between them and the 1 in 3 who never claim a dollar. And now you know it exists too. Let me make that real with one person. Picture a single senior on a modest Social Security check who happens to qualify for all three. Her state picks up her Part B premium that's around $2,400 a year back in her check. The energy program covers a chunk of her heat in the winter and her cooling in the summer, several hundred more. And a partial SSI check quietly tops up the months that used to come up short. Stack those together, and you are looking at thousands of dollars a year tax-free flowing to a woman who 12 months ago would have told you flat out that the government didn't owe her a thing. That is what claiming all three can actually look like. Now, before I give you the last and most important piece, I want to mention something I put together because so many of you have asked me for it. Everything I cover on this channel, the benefits most seniors never claim, the checks and credits hiding inside programs you already touch, the tax breaks, the ways to protect your Social Security and your home, all the moves that keep every dollar you're owed in your own pocket. I put all of it in one place in plain English in a guide called the Senior Money Playbook. It's written so it's easy to follow step by step with the actual numbers to look for and the exact words to say when you call. If you want it, the link is down in the description below, but everything you need to take the first step on all three of these is right here in this video. So let me give you that last piece. Now here's what I want you to do. Do not let another year go by leaving this money on the table because you assumed at your own kitchen table that you didn't qualify. Take these one at a time. For the Medicare Savings Program, call your state health insurance assistance program, SHIP, or your state Medicaid office. For the energy help, dial 211 or find your local energy assistance office and do it soon while the funding is still there. And for SSI, go straight to Social Security. All three are free to apply for, and remember what I told you about that phone. The government is not going to call you and ask for your bank number to hand you these benefits. You go to them. You never give your information to whoever called you. Because here is the truth underneath all of this. Nobody is going to knock on your door and hand you what you're owed. The system is quietly set up to keep paying only the people who ask, and it will happily let you go your entire retirement, never claiming a dime of this if you let it. The only person who is going to make sure you get every dollar with your name on it is you. If this opened your eyes, do one thing for me. Share it with someone you love who's 65 or older, especially anyone on a tight fixed income who's convinced the government doesn't owe them a thing. They may be sitting on thousands of dollars a year they have never once heard of, and they are the least likely person to ever go find it. You can be the reason they finally do. Subscribe. Turn on the bell so the next one finds you. Anytime a customer makes a cash transaction that exceeds $10,000 in a single business day, that report is filed on Finansin Form 104. It includes your full legal name, your Social Security number, your date of birth, your home address, the exact amount, and the time it happened down to the minute. The bank has 15 calendar days to file it. You will never see a copy, and the bank is legally prohibited from telling you it happened. That's the rule under 31 United States Code Section 5313. I want to be precise about what actually triggers this, because people get confused here. This rule is about cash physical currency, and in certain cases, cash equivalent instruments like money orders and cashier checks. It is not triggered by a regular check, you deposit a normal wire transfer, or your Social Security direct deposit landing in your account. Those everyday electronic movements aren't what this rule is targeting. And one more detail that catches people off guard. The bank adds up your cash transactions across the entire day. Depositing $5,000 at one branch and $6,000 at another branch that same afternoon still adds up to $11,000 in the bank size. You cannot get around the threshold by splitting locations. Now, here's what people get wrong in both directions. If you're a lower-income retiree, your deposits may rarely come close to $10,000, and that feels like safety. It isn't. I'll show you why in a moment. If you're a retiree with meaningful savings, you may be moving money between accounts, receiving pension disbursements, or consolidating accounts after a spouse passes, and every one of those moments is a potential flag. Both groups can walk out fully protected. I'm going to tell you exactly how. For each one, a currency transaction report by itself is not an accusation. It's mandatory paperwork. Millions get filed every year, and the overwhelming majority trigger absolutely nothing. The problem isn't the report. The problem is what happens next, and that leads directly into the second rule. Almost nobody explains because $10,000 isn't even the number you actually need to worry about most. The real number sits below it. There's a second type of report banks file, and this one has no dollar threshold at all. It's called a suspicious activity report, a SAR, and a bank can file one on a transaction of any size, $2,000, $500. There is no floor. The decision comes from the bank's internal compliance software scanning your transaction history for patterns, not crimes, patterns. And the pattern that trips a SAR fastest is a series of deposits that added together would have crossed $10,000. Anything that looks designed to dodge the reporting requirement. Take a woman named Diane. She's 67, a retired registered nurse outside Nashville. She sold her car for $11,000 in cash because the buyer didn't have a cashier's check that day. Diane had heard somewhere that $10,000 was some kind of government line. So she deposited $5,000 on a Tuesday and $6,000 on a Friday. Two separate trips, her own money, a completely legal sale. The bank's software saw two large deposits in 1 week from an account that had never held more than $3,000, and it filed a SAR with FinN. Diane did nothing wrong, but that report now sits in a federal database, cross-referenced against everything she does going forward. Here's the part that costs people the most. The bank cannot tell you a SAR was filed. A bank employee who tips you off commits a federal crime called tipping off, punishable by up to 5 years in prison. So the silence isn't an oversight, it's the law. And that leads directly into the most dangerous part of all this, because once people learn about the $10,000 rule, they all have the same instinct. That instinct is a felony. Pause for a second and pull up your actual checking balance. Not last month's statement, today's number. Hold that in mind because everything from here applies directly to it. When people hear about the $10,000 reporting rule, the first thought is almost always the same. Keep deposits under it. Split it up a little today, a little next week. That instinct is not a workaround. It's a federal felony called structuring. Under Title 31, U.S. Code, Section 5324, it is a crime to break up or help break up any transaction with the purpose of avoiding the currency transaction report requirement. You don't have to be laundering money. You don't have to be committing fraud. If every dollar you have is completely legal, earned, inherited, gifted, and you deliberately deposit it in smaller pieces to stay under $10,000, you've committed a federal offense. The penalties are severe, under $100,000 in a 12-month span, up to 5 years in federal prison, and up to $250,000 in fines. Over $100,000 are tied to other illegal activity up to 10 years. And in both cases, the government can seize the money through civil asset forfeit before any conviction happens at all. The burden then falls on you to prove the money was legitimate. And while you're proving it, the money is already gone. This isn't theoretical. A federal watchdog, the Treasury Inspector General for Tax Administration, reviewed a sample of these structuring seizures and found that in the cases where structuring was the stated reason for the seizure, the overwhelming majority, over 9 out of 10, involved money that had been earned completely legally. The law was written to catch drug traffickers and money launderers. In practice, it was overwhelmingly hitting ordinary, honest account holders. That public outrage forced real reform. In 2015, the IRS announced it would stop seizing legally sourced funds in most cases. And in 2019, Congress restricted the IRS, specifically from seizing accounts on structuring suspicion alone when the money came from a legal source. But those reforms apply to the IRS. The Department of Justice can still pursue these cases, and structuring itself is still very much a crime on the books. The lesson hasn't changed. Never break up a transaction to dodge that line. Here's who gets caught in this most often: retirees who receive irregular large lump sums rather than steady paychecks. A final pension disbursement, a life insurance settlement, proceeds from selling a home or a car. An inheritance, a retroactive Social Security payment that lands all at once. These aren't wealthy people doing anything unusual. They're careful people whose income arrives in large, infrequent amounts that look strange to software built to catch criminals. And you will never be told any of this happened in real time. It's also worth understanding why retirees specifically get flagged more than working-age account holders. When you were employed, your money mostly moved in one predictable shape. One paycheck, direct deposited, same amount, same schedule. Retirement income doesn't work that way. You might have Social Security landing on one date, a pension on another, investment dividends on a third, and then layered on top of all that, occasional large one-time events, a required withdrawal, a home sale, a settlement. Automated monitoring systems are built to notice variation, and a retiree's financial life is naturally more varied than a single steady paycheck. On top of that, a lot of retirees no longer have an accountant or advisor sitting beside them the way they might have during their working years. So these situations build up quietly, unmanaged, until one of them causes a real problem. None of this means anything is wrong with how you're handling your money. It just means the system was built around a different, more uniform pattern than the one retirement income actually follows. There's also a broader context worth knowing. The Bank Secrecy Act was passed in 1970 to combat money laundering and organized crime, and it was expanded significantly after 2001 under the USA Patriot Act to include terrorism financing. The system was built to catch criminals. It was never built to target retirees. But the software scanning your account doesn't know the difference between a grandmother moving her own savings and someone moving illegal funds. Both patterns can look identical to an algorithm. Documentation is what tells them apart. And to be clear about what a CTR filing actually means for you, Finanzen collects the reports and the IRS may access them during an audit if some other separate reason for suspicion already exists. A CTR by itself is not an audit trigger. It's a data point sitting in a database that only matters if something else brings investigators to it in the first place. So, here's what I want you to do. The exemptions, the breaks, the refunds, most seniors already qualify for but never claim. I've put them all in one place, state by state, form by form, so you don't waste hours digging through government sites. Everything's laid out fast and simple, so any senior can find exactly what applies to them. No matter what state you're in, there's money you're leaving on the table. It's called the Senior Exemption Playbook. It's in the first pinned comment right below this video. Just tap it once and you'll have everything you need. Now stay right here because the next part is the single most important protection most seniors never use. And it's the reason I made this whole video. The protection isn't avoidance, it's documentation and transparency. That's the only thing separating a routine CTR filing that goes nowhere from a real problem. Take a woman named Sylvia. She's 71, a retired elementary school principal from Baton Rouge. Her brother passed away and left her $38,000 from his estate. She walked into her bank, deposited the full amount in one transaction, handed the teller a copy of the estate settlement letter and the will naming her as beneficiary, and asked the teller to note the source. A CTR was filed. Sylvia never heard another word about it. The documentation made sure of that. That's the principle. Deposit the full amount in one transaction. Bring paperwork that explains the source, a bill of sale for a vehicle, a gift letter from your child stating the amount, the date, and that it's a gift with no repayment expected, an estate settlement letter, a pension award letter, a Social Security notice of payment. Keep a copy. You'll likely never need it, but if the question ever comes up, you hand over the answer instead of scrambling for one. There's more to protecting yourself here than the deposit itself, and this is where I want to add a few things that don't get talked about enough. One useful habit is keeping your money in separate buckets instead of running your whole financial life through one checking account. Your checking account should really only hold 1 to 2 months of living expenses, plus a small cushion. It's your wallet, not your vault. A separate high-yield savings or money market account FDIC insured is a better home for your 3 to 6 month emergency reserve, and it actually earns you something instead of sitting at a fraction of a percent while inflation quietly eats it. Money you won't touch for a year or more can work harder still in something like short-term treasury bills or CDs. Beyond keeping your accounts cleaner and less flag-prone, this structure solves a second, quieter problem. Idle cash in checking is losing real value every year. It just sits there. If you're 73 or older and required to take a minimum distribution from a traditional IRA or 401k, a lot of people take the whole thing as one lump sum in December and drop it straight into checking, which is exactly the kind of single large deposit that stands out, if your plan allows it. Taking that distribution in smaller scheduled amounts across the year is not structuring. Structuring means breaking up a transaction specifically to dodge a report. A scheduled ordinary distribution setup for planning reasons is completely legitimate. The difference is intent, and a routine recurring withdrawal reads nothing like someone trying to hide something. Family gifts matter here too. There's an annual gift tax exclusion, $19,000 per person per year for 2026 that you can give or receive without triggering a gift tax filing. Go over that amount, and you're generally supposed to file Form 7009, not necessarily to pay tax, just to report it. Large, untracked transfers between family members are exactly the kind of thing that becomes a headache if your account ever gets a second look. So, keeping a simple written record protects you either way. Two more things worth knowing. First, a single high-income year, a big retirement account withdrawal, a Roth conversion, and inheritance. Selling a rental property can push up to 85% of your Social Security benefit into taxable territory. And separately, it can trigger ARMA-A, the income-related adjustment that raises your Medicare Part B and D premiums 2 years later based on that year's income. People take one big distribution, forget about it, and get blindsided by a higher Medicare bill years afterward. Spreading large income events across tax years when you have the option quietly protects you on both fronts. Second, if you're now using apps like Venmo, PayPal, Zelle, or Cash App for selling things or receiving money from family, know that activity can generate its own tax paperwork. And if those apps feed directly into your main checking account, it all blends into the same picture the monitoring systems are watching. That doesn't mean stop using them. It means keep that activity as organized as everything else. Here's your action plan. Step 1. Before you deposit any large sum, gather the document that proves where it came from. The bill of sale, the estate letter, the gift letter, the pension notice. Step 2. Deposit the full amount in a single transaction. Never split it across days or branches. Step 3. Hand the source documentation to the teller in person and ask them to note it on the transaction. You're allowed to do this, and it protects you. Step 4. Keep a personal file, physical or scanned, of every supporting document for any transaction over $5,000. Step 5. If you're moving your own money between accounts or closing one after a loss, do it as a single wire with a memo line explaining why, and keep both statements showing the same day transfer. Step 6. Never, under any circumstance, break a deposit or withdrawal into smaller pieces to stay under $10,000. A large legitimate transaction is fine. Trying to dodge the report is the only thing that's actually dangerous. One more thing before you go, because I think it's the most reassuring part of everything I've covered today. None of this means you should keep cash at home to avoid the banking system altogether. I understand the appeal. No bank, no reports, no algorithm watching, but that's a bad trade. Cash sitting in a house isn't insured. If there's a fire or a theft, it's simply gone with no way to recover it. Large amounts of cash can create their own legal complications if you're ever asked to prove where they came from. And like idle checking balances, cash at home loses real value to inflation every year while earning you nothing. The answer was never to hide your money. It's to organize it. Clean structure beats concealment every single time. Your bank isn't required to explain any of this to you, and it isn't allowed to warn you after the fact either.